Okay, now I don't want you guys to all run screaming out the door when we start talking about basis again here. I know that this one, basis is a bit of a challenge. I don't know if it'll be any more or less understandable for corporations. I know that inside-outside basis concept in partnerships is pretty complex. I think anyway, basis is a little bit easier to understand with regard to corporations because, I mean, with partnerships, partnerships, sorry, my glasses are dirty. Partnerships are kind of, because they're a pass-through entity, they're, it's like they're an extension of the individual. Whereas for corporations, there's much more of a separation between the individual owner and the corporation itself. And so I think the concept, for me anyway, the concept of basis is a little bit easier to understand when we're talking about corporations. So there is, however, we've got two bases, right? We've got the basis of the ownership interest. So in this case, it's stock. So the owner has basis, and we already did that stuff in chapter 7, right? When we were talking about gains and losses, we talked a lot about stock. That's what we're talking about here with C corporations is owners of C corporations own stock. And whatever the value of that stock is, whatever the value of it was when it was obtained, and then when whatever they sell it for is going to determine any gain or loss. And you don't have any adjustment in the meantime to any of that. So what we're talking about here is just simply stock. So to the shareholder, their basis is going to be whatever they paid for the stock, right? Whatever that basis, that their ownership interest in their hands, but then there's also basis to the corporation for property that was exchanged for the ownership interest. So remember, we've got to the owner of that stock that stock didn't just magically appear, right? Something was traded for it. There was some sort of consideration given for it. So, and when we talked about partnerships, remember we talked about what happens if it's cash. Cash's basis is its basis, right? If I pay $10,000 to buy into a partnership, then my basis at that point anyway in that partnership is $10,000. Cash, same thing for corporations. If I pay $10,000 for 100 shares of stock in a C corporation, my basis in those 100 shares is $10,000 because that's what I paid for it. But there are different rules with regard to basis when it's not cash, right? Remember with partnerships, that basis essentially just transferred over. If I gave a building with a basis to me of $100,000 to the partnership, then that was my basis in the partnership. That basis just transferred over, and then I took that amount of basis in the partnership. There were some different rules if I had a liability against that building, right? Or there were also, but I didn't recognize any gain or loss at that point. The only time I recognized gain or loss, remember, is if I contributed services in exchange for my partnership interest, right? So the rules for corporations are just a little bit different. They're not different with regard to buying corporate stock for cash. That's not any different. But with regard to transfer property, a little bit different. So let's take a look at all this. So also there are some rules. There are some differences with regard to how much control the owners have after the transaction. So if the transferors control 80% or more of the corporation immediately after the exchange, generally speaking, the exchange is tax-free. If they don't control 80% or more, then it's a different story. So let's look at an example. We got Marty and Sarah. They are forming Boone Company. Marty is transferring $1,000 cash in exchange for 100 shares of stock. So his basis is $1,000, $10 a share, right? Sarah transfers a bond, not cash, but a bond. Bond has a fair market value of $1,000, basis of $800. So her basis is 800 for 100 shares. They are the only two shareholders. Because they control 80% or more immediately after the exchange, the transaction is tax-free. Now, her basis then would be the $800. So even though she's getting 100 shares of stock, her basis in that 100 shares is the $800. So when that 80% rule is met, there are two times when the shareholder does have to recognize gain. When the individual transfers property subject to a liability, that sounds familiar, right? Same with partnerships. And the relief of the liability is greater than the transfer's basis in the property. In this case, the gain is equal to the excess of the liability over basis. All right, so now we're getting into a lot of words here. Let's get an example. So it gives us a little clearer picture. Now we've got Gina. So Gina transfers an apartment building to GGG Company. In exchange, she gets all of the stock in the company. Okay, so she owns it 100%, right? The building has a basis of $100,000, fair market value of $500,000, and a liability of $300,000. Okay, so now you can see the liability is greater than the basis. So what she owes is more than the basis of the property. That wouldn't be, it seems kind of weird, but not necessarily, because this building may have appreciated significantly in value. Its fair market value is $500,000, right? Maybe she originally bought it for $400,000. But she's depreciated it, so now it's got a basis of $100,000, but she still owes $300,000 on the building. Okay, so even though she controls more than 80% of the company immediately after the exchange, she owns 100% of it, the transaction is taxable because she has debt relief of $300,000. Now she doesn't owe the $300,000 in excess of basis. So she is going to have a gain of $200,000. The difference between the debt and the basis of the property is the gain that she is going to have to recognize. Okay, 200,000. That's the first case. Second case, when an individual contributes cash or property and receive in exchange, not just stock, but some other cash or property. They call this boot. So the taxable gain is the lower of the fair market value of the property received or the realized gain. So let's take a look at how that would work as well. Examples are a little bit easier to understand. Now we've got Ernie. So remember, this is when you are giving the corporation maybe cash. The corporation is giving you stock, but then they're also giving you something else, maybe a piece of property or something like that. So to the corporate entity, I'm sorry, Ernie receives all of the stock of EBU Company in exchange for contributing a machine with a basis of $15,000, fair market value of $25,000. Okay, so his basis is going to be the $15,000. He also receives $3,000 cash from the company. So Ernie gave a machine. Ernie received stock and $3,000 of cash. Kind of sold that machine to the company, but he's getting stock in the deal. The gain on the transfer is $10,000. So the difference between the basis and the fair market value of the machine. So this is his total gain. He has to report $3,000, which is the lower of the gain or the cash received. Okay, so his basis now in the company is 15,000, but he had a gain of 10,000 of which he has to report 3,000. So it's going to be whichever is lower, the $3,000, the gain, which was 10,000, or the cash that was received, 3,000. He's going to have to report $3,000 as a gain. So if we look at our examples down here, so here's Ernie, his gain that he reports, so he's going to have, you know, it's probably a short-term gain, 3,000 that he's going to have to report. His basis in the stock is now $15,000. That was the basis of the machine. The corporation's basis that they're going to start with is going to be the sum of the shareholder's basis plus the boot that was reported. So in Ernie's case, it's going to be 18,000, the 15,000 plus the 3,000. For Gina, her reported gain, remember, is $200,000 here. Now her basis in that stock is actually going to be 0. So, because she's, let's revisit her for a second. Because she's being relieved of that 300,000, it's going to be greater than the basis of 100,000. It would be 100,000, but we're subtracting that 300,000 from it. We can't go below 0 though on basis, remember? So it's 0. And then the proper basis of the property, I'm sorry, basis to the corporation of that property is the $300,000, which again, so it would be the, where is it here? Oh, the amount of debt that was assumed by them, because now they've got to pay that 300,000 off. Marty and Sarah, yeah, so there's Sarah's basis is $800 because that's the fair market value of what she contributed. I'm sorry, the basis of what she contributed. Marty 1,000, and then it would be equal to the corporation. Shareholders do not recognize losses upon the formation of a corporation when that 80% test is met. So what about services? If an individual provides services, the individual will recognize ordinary income equal to the fair market value of the services. So that is the same as we discussed for partnerships, right? There is no adjustment to the outside basis, this amount, over time, unless they purchase more, right? Unless they purchase more shares of stock, or if they sell some of their stock. There's no adjustment to it, okay? S corporations are different in this regard. They're like, the S corporation basis is like the partnership basis in that you've got to track it over time. You got to keep tracking it. So it will go, and it's affected by many of the same items as for partnerships. Okay. C corporations, you buy the stock, your basis is however much you paid for it, and it doesn't change over time unless there is some difference in the amount of stock that you own, right? So that big thing is the 80%. That's where if it's over 80%, then there could be this gain. If it's not over 80%, I'm sorry, if it's over 80%, then there's only 2 instances where you'd have to recognize a gain. If it's under 80%, then you may have to recognize a gain on the exchange. Let's see. So Arturo contributed land. Let's look at this. Arturo contributed land with a fair market value of $100,000 and a basis of $40,000 to a newly formed corporation in exchange for 90% of the stock. So that's over the 80%, but it doesn't really matter at this point because they're not even asking us if we're gonna report any type of gain or not. But what is his basis in the stock? Anybody want to take a gander at that? No? Remember, the basis is it's going to remain the same. It's going to be his basis. Here, we don't have any liability or anything to deal with. So it's just simply going to be the $40,000 that transfers, that basis is going to transfer over. Okay. All right. Questions? All right.